Over the last couple of weeks, private sector banks have reported Q2 numbers, and we are in an environment where not just loan growth is improving, but we are also seeing an improvement in private banks' overall profitability. Let's understand the reasons behind this. Private sector banks have made the most of rising interest rates by passing on rate hikes. Now, the rise in profitability private banks are witnessing right now is aided by the combination of loan rate hikes and delayed deposit rate hikes. Now, strong profitability reported by top private banks is on the back of robust growth in net interest income, which is the difference between the yield a bank earns on loans and the interest it pays on deposits. When interest rates are growing in the economy in a scenario such as this, net interest margins becomes greater as seen on the chart on your screen. On a positive note, provisions, that is the loss of loan, have also been reported lower as shown in the Q2 results. Now, this is on the back of an improvement in asset quality as seen in the declining trend in gross non-performing asset ratio. Credit growth has been making headlines every fortnight with the credit offtake staying in the double-digit growth curve, but deposit growth hasn't kept much pace. Now, the banks have enjoyed good margins in Q2. However, going forward, the deposit rates are going to move up because of a liquidity crunch. This will have an impact on the company's margins. The topic of recession dominates market commentary these days. In Q2, the US economy shrank for the second straight quarter. But in the third quarter of this year, the US economy grew by 2.6% after experiencing 2 quarters of negative GDP growth. Let's discuss this. While the growth in GDP reflected a rise in exports, consumer spending, government spending, growth in consumer spending, which accounts for more than 2/3 of US economic activity, slowed to about 1.4% rate. The trade deficit narrowed sharply as slowing demand curbed the import bill, while exports increased on the back of oil sales. Now, if we see, the trade deficit has given a huge boost to the overall GDP number for the US. Residential investment, which is interest rate sensitive, has also weakened as mortgage rates have surged. The US economy rebounded in the third quarter, exceeding expectations after contracting for the first 6 months of this year. Now, the positive headline reading, however, hides some trends that are less encouraging. While the US may have just exited a technical recession, the US GDP does point to the US economy losing strength on the back of slowing demand. Higher interest rates will likely crush demand going forward too. So what does these news mean for you? Deposit growth is expected to see some uptick in the current rising interest rate regime. But healthy credit growth and reducing concerns on asset quality is leading to an increase in profitability for the banks. This will have an indirect positive impact on you. The US economy faces risk from global economic headwinds and monetary policy tightening. Hence, the outlook is deteriorating. But some areas of the US economy have maintained momentum, with the labor market still strong. This will have an indirect neutral impact on you. While I say this is me, Merlin Susanna, signing off. Take care and stay invested.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.